I remember taking this class as I was prepping for my Series 7 designation. That's the license you need to be able to trade stocks. And it's this super difficult test, and lots of people fail it. So after doing the at-home study course in the pre-internet days, little old Joe story here, I took this in-person classroom experience thingy. That was the technical term, I'm sure. Classroom experience thingy. But the teacher, who is this longtime trader, he told us all kinds of stuff. And it was cool because, like in our sessions before lunch, he would tell us how the markets work. And then I would go and I would find examples of it in the newspaper. Like I was so fried. I'd just go grab some food at a food court, grab a USA Today, sit and eat just to get away from the class. Some people would stay there. I would go do that. But as I'm reading the money section, and it's examples of all the stuff I'm learning in class. I thought it was so awesome that I remember coming back from lunch one day and I raised my hand and I told the guy, I said, I've got these examples of these companies doing these things that you're talking about, these mergers, what things about data with the market, like all of this stuff, all this news. And he said, yeah, isn't that all great? And I said, yeah, it's fantastic. I can't believe that you're teaching me this. He goes, well, the theory's great, but ignore the rest of that because none of it is going to appear on the test. Live from the 3-room apartment above Uncle Jack's garage while we're renovating the basement. Hey there, stackers. I'm Joe Saul-Sehy, Average Joe Money on Twitter. This show is called Money in the Morning. It's the place where we take not one, but two financial headlines. And not only do we read them like some shows do, but we actually answer the question, what the hell does this have to do with me? We'll do that, and then we'll combine the two ideas during the show for something you get to take home called the big idea. Money in the Morning is brought to you by Tiller. Here's how Tiller works. It's all your finances automatically updated in Google Sheets or Excel every day. 83% of Tiller customers say they're more aware of where their money's going. Still my favorite stat. 83% of Tiller customers. I use Tiller. I don't know what those other 17% of people are thinking. But anyway, try Tiller for free if you use our link, stackybenjamins.com/Tiller. That's TILLER, stackybenjamins.com/Tiller. Thanks to everybody who's used it using our link. And we'll talk a little bit more about Tiller later in the show. But today, big news out in the stock market, big news for your retirement plans, lots of stuff going on. So Laura, why don't you get this party started?
And now, your first Money in the Morning headline.
We're going to do something that they also do in Canada. Tom Drake was recently a guest from the Maple Money podcast. Sometimes hangs out with us here. Maybe we'll have a Tom sighting today. But Tom taught us some Canadian terms. And he asked us what a twofer was. Do you remember that one, Richie, what a twofer was? Richie, our producer here. It's a 24-pack of beer, apparently, in Canada. But here in the U.S., a twofer is when we don't just give you one headline, we give you two for the price of one. So for the price of exactly free, we're going to throw in an extra one because I think these two headlines together, when you couple them, make the point that we're trying to make today. The first one is this. This one is from Thursday. It is written by Fred Imbert at CNBC. Stocks jump again, bringing the 3-day gain in the Dow to more than 900 points. Stock closed higher Thursday as a rebound from sharp losses last month continued after comments from President Donald Trump indicated potential progress in U.S.-China trade relations. The Dow Jones Industrial Average gained 264.98 points to 25,380.74 is Dow DuPont outperformed, bringing its 3-day gain to more than 900 points. S&P 500 also climbed 1.1%, with the materials sector leading. NASDAQ Composite advanced 1.8%. Ahead of Apple's quarterly earnings report. Trump said in a tweet Thursday he had a, quote, long and very good conversation with Chinese President on trade. He also said meetings between the two at the upcoming G20 summit are being scheduled. Quote, it's positive that the two leaders are speaking, said John Adams, investment strategist at BMO Global Asset Management. We think shorter term we'll have these tensions as a headwind for the market, but in the intermediate term, we think a deal will get done. And then they go into talking about October being a volatile month. Don't know if you know this, but October was a volatile month. That's headline number one. Now let's move into headline number two, and then we're going to bridge the two of these together. By the way, this is a twofer. This is actually, for our show's purpose, one headline, but we're juxtaposing, to use the $5,000 word, two headlines against each other. Second piece, also from CNBC, comes to us from Jeff Cox. This was published Friday morning. Payroll smash estimates with gain of 250,000. Wage gains passed 3% for the first time since the recession. Job growth blew past expectations in October, and year-over-year wage gains jumped past 3% for the first time since a Great Recession, the Labor Department reported Friday. Non-farm payrolls powered up by 250,000 for the month, well ahead of Refinitiv estimates of 190,000. The unemployment rate stayed at 3.7%, the lowest since December 1969. The ranks of the employed rose to a fresh record of 156.6 million, and the employment to population ratio increased to 60.6%, the highest level since December 2008, according to the department's household survey. That headline jobless number stayed level even amid a 0.2 percentage point rise in the labor force participation rate to 62.9%. Those counted as outside the labor force tumbled by 487,000 to 95.9 million. But the bigger story may be wage growth, which has been the missing piece of the economic recovery. Average hourly earnings increased by 5 cents an hour for the month and 83 cents year over year, representing a 3.1% gain. The annual increase in wages was the best since 2009. That number is being watched closely by the Federal Reserve, which has increased its benchmark interest rate 3 times this year and is on track for a 4th quarter-point hike in December. Higher wage growth feeds into the central bank's desire to raise rates to keep inflation under control. Man, there's a lot there. 2 headlines, supposedly 1 point, but I got to go through a couple of these things. Number one, why does the Fed think wage growth means that they should raise interest rates? Well, here's the deal. When companies pay people more money over the short run, that is a good thing for the economy. Over the medium term, though, what do people do? They turn around and they spend that money. And then you end up seeing then prices end up going up because companies think, well, hey, lots of people buying our stuff. I can raise prices without losing sales. So then they raise prices. And then that, ladies and gentlemen, is inflation. And so wage growth is good over the short run, means products are going to cost more in a little bit longer run. That's like the next domino. And then boom, inflation. So what does the Fed do to curb spending? They make you pay more interest to the man. And we live in a society where we think about those things, spending things. We don't think enough about savings things. That's a whole different podcast, though. That's point number one. And so wage growth over the short run, fantastic news. And by the way, the Fed raising interest rates in December, most traders have already baked that in because we've seen the Fed raise interest rates quarter over quarter over a long period of time. So we feel like we're already on that trajectory. So in a lot of cases, if the Fed had been lowering interest rates or had been even and not doing anything, and it was the first bump, traders would get worried. But the fact that we're on this train, this escalator of raising rates, you're seeing a lot of traders yawn. So that's number one. But let's get to the real point here. Our first headline was all about trade talks and the stock market going up on trade talks. That, if you're categorizing this in your head, that is categorized as news. And over the very, very short run, news moves the market. Pay attention to news because news moves the market. Over the longer run, though, news is nearly irrelevant. The bigger thing is data. And so news over the short run produces these short spikes in the market. But the data, the second piece, this is data about much, much bigger stuff. And on a quarterly level, stocks, U.S. creating 250,000 jobs, wage gains, that's data. Data doesn't move the market as much over the short run, but data gives us things to work on over the long run. It's the fabric of investing over a longer period of time. So when I'm paying attention to the markets, I'm paying a lot more attention to data because that shows me long-term trends than I am news. News can sometimes show trends, but data shows me a lot more. So I think our first takeaway here is news, short-term. If you're a day trader, pay attention to the news. If you're a long-term trader, you can by and large forget about the news and instead wait for the data points to come out. The data points come out. If you're going to make investing decisions on that, I think it's a safer place to be. If you look more at your long-term goals, I think you're even safer than that. So that's that. Let's say hi to everybody hanging out with us here on Facebook today. We've got Brittany here, Jesse's here, John is here, Paul's here, Kevin's here, Bill is here. Good to see Bill in the audience today. Ron's here, Danny, who is in Detroit with us, is here. Aaron is here, Joe's here. We've got a nice little group with us today hanging out on Facebook. Paul says in his interest rates raise, we might get more than 0.0001 in our savings account. You know, it's funny. In a recent earnings report, Bank of America said they didn't raise their interest levels on their savings account because customers didn't demand it. We truly live in a society that's all built on spending, not built on saving. Not built on it at all. I wish it were the other way around. But when economic indicators are all around how much money people are spending, huge sea change needs to happen. Like the fire movement needs to be a lot bigger. Chris writes, I wonder what portion of wage increase came from a small number of large employers. It probably doesn't account for Amazon's announcement during the stats period. You know, economic numbers are lagging indicators, and generally, and I'm not sure what date this is. No, this is October. So if any hiring that actually happened, Chris, in October, in this number, anything that didn't happen in October, just an announcement of future stuff going on. If you're talking about Amazon announcements around raising wages, if they did it, yes. But I don't think Amazon has done it yet. I think it was just an announcement that they are going to do that. So no, hasn't been baked in yet. Of course, Brittany says you can go to Magnify Money and get 2%. Brittany's fantastic. Taking care of our sponsor. But actually, seriously, they're our sponsor on Stacking Benjamins because there is no place where you can compare more spots. So, and I'm not sure, is Beam open yet? You know, we had the founders of Beam, the really, really high interest savings account, on the show, but I don't know if they're open yet. I know they a couple weeks ago were not open yet when I checked, but Beam should be open fairly soon. If only there were a way for me to look that up, but I'm not going to do it while we're recording this live. That's our first headline and our first takeaway. Let's move on to our second piece today, guys, which comes to us from, this is good news for everybody, comes to us, well, from just about everywhere, but we got ours from MarketWatch. Listen to this. Saving money into an IRA, into a Roth, you can finally put more in starting next year. This is written by Steve Goldstein. IRA contribution limit lifted for the first time in 6 years. The Internal Revenue Service on Thursday unveiled the cost of living adjustments for pension plans and other retirement items for the 2019 tax year, including the first increase to the contribution limit for the individual retirement arrangement in 6 years. The limit on annual contributions to an IRA has increased to $6,000 from $5,500 for the 2019 tax year, while the limit for employees who participate in a 401k, a 403b, most 457s, and the federal government's TSP, that increases from $18,500 to $19,000. The catch-up contribution limit, catch-up, different type of catch-up. The extra contributions employees age 50 or over participate in 401ks, 403bs, most 457s, and the TSP remains unchanged at $6,000. Short story, big things when it comes to your plan. Here come the adjustments, kids. Get out the calculator. Change your 401k withholding effective January 1st. You can now put more money away. And it's about time. 6 years it took us to get this. So stuff a little more in. You're going to be that much happier next year. Whether you have a 401k, 403b, 457, TSP, or IRAs, Roth IRAs. If you're over 50, getting a lot more money in there. I don't think there's a takeaway other than do it, adjust it, make it happen, make it so. That's probably our takeaway from number 2, which is good because we spent a lot of time on the first one. Hey, in a second, guys, we're going to take these 2 headlines and we're going to put them together into something that we call the big idea, which how are we going to talk about these daily numbers and also talk about IRA contributions raised? Oh, we'll have that in just a moment. But first, I want to talk briefly about Tiller. Later on today, I'm going to be making a video of how I opened my Tiller account and what it shows inside. We're going to have that, but don't wait for me because you can kick the tires for a month for free using our link at stackingbenjamins.com/Tiller. But the way that Tiller works is that it connects your financial accounts to spreadsheets and automatically updates them with your daily transactions and balances. And I know what you're saying. You're going, oh my God, spreadsheets? No, thank you. Don't need another spreadsheet. Or maybe you're the opposite. You're like, dude, I already got my own spreadsheet. I don't need a Tiller spreadsheet. But wait, there's more. The cool thing for people like me that go spreadsheet, no thank you, is that Tiller comes with templates. And there's even a Stacking Benjamins template in there that shows how OG and I love thinking about managing money, puts everything in simple cells for you to use. Also, you can build your own template or riff off the template once you have that. So you don't have to start from scratch. And it makes it not seem like a spreadsheet as much as the most versatile program you've ever used. You know those things that you hate about Mint or you don't like about Clarity Money or whatever you use to track your expenses? Tiller takes all those away because you can make it however you want. On the other side, if you love spreadsheets, you've got one problem, which is adding in all your data. Well, Tiller gives you the single button press where all of your transactions filter into the Tiller sheets and then do with it what you will. It safely and securely moves from your other accounts into your Tiller sheets. Try it for free for a month if you use our link, stackingbenjamins.com/TILLER. Good stuff. Good stuff too, people, by the way, talking about our second headline, which is this. Tim says it's great news. Kimberly says it's nice that the limits were increased for retirement. Woohoo. Ray says, got to move that money out of the mattress into the IRA. Should have been in the mattress in the first place. I love that. That's funny. Eric's here. Hey, Eric. Good to see Eric with us this morning. Worried about stuffing money into the market when it's at an all-time high. Why not spend it when savings are almost assured to decrease when the market tumbles? Here's the problem, dude. You got to have the crystal ball, right? And you always lose when you're trying to guess which way the market's going. Start with the long-term plan and work backwards from there. What do I need to put away? What's the right place to put it? The market's at a high 70% of the time. So we're often saying that the market's high. And I know that it's shaken lately, but if we look at 10, 15 years from now, none of that's going to matter. So I definitely prefer focusing on that first. Jared's here today. Who else is checking in? I think that's it. Paul weighs in, says $500 a year. What does that really mean? You mean $500 a year more? Think about that cumulatively, Paul. Number one, you can put $500 more in, and you also get the interest on that money over time. Let's actually do let's have some fun here for a second. Let's take the rule of 72 and which Paul actually talked about on Cash Crunch Games, and let's apply it to $500. So let's say that you're 30 years old right now, and you're going to get, let's say, an 8% rate of return. 8 divided into 72, 9, right? Meaning what the rule of 72 is, it's this mathematical magical number that if you take the interest rate you think you're going to get, 8, divided into 72, it pops out how many years is going to take your money to double. So every 9 years in this case. So that means that $500 that you save this coming year that you weren't able to save before into the Roth, and let's say that you just weren't saving it and you find a way to save the extra $500 to stuff it in. Now at 39, it doubles again at 48, at 57, and then again at 66, right? So we're looking at Social Security age 67 for a lot of people. So we've got 4 times that money doubles. So that's not an extra $500 you're putting away, is it? 500 becomes 1,000 that first 9 years. Second 9 years, that 1,000 becomes 2,000. 2,000 becomes 4,000. 4,000 becomes 8,000. Every year, that's an extra $8,000 worth of spending in retirement you'll get. Now, I understand that inflation has gone up, but at a much slower rate. So powerful. I think it's powerful. Then you have the cumulative effect of saving money on your money. It's pretty darned exciting, saving that $500. It's good stuff. All right, time for the big idea, guys. So our first headline, we talked about the stock market, and we went over 2 headlines. One that was news, which makes a lot of sense over the short term, but then the second one talked about stock market data that came out on Friday and is far more important over the medium term and longer term. Then our second headline, IRA limits finally raised after 6 years. And I think this makes a point. And actually, Paul makes a good point when he says $500. What's that all about? Planning isn't about the big move. I used to, when I was a financial planner, I was surprised when sometimes clients would say, you know what? We met 6 months ago, really don't need to meet again, don't have a lot. And it was funny because people that thought that way often then struggled, because when we did meet, we'd have these monster meetings making huge changes, when really effective planning is all about making these little tiny course corrections, not making the big move. It's about tweaking a little bit at a time, finding this little thing, fixing that, finding something else little, fixing that, finding something else, improving that. These little tiny moves. And if you make the little tiny moves in a timely manner and the machine keeps humming efficiently, that extra $500 a year, as we just showed, can end up being a lot of money. So when you take advantage of and find ways to take advantage of those small moves, I think that creates the big change that we're all looking for. That's Money in the Morning today. Thanks for hanging out, everybody, on Facebook. Thank you for everybody listening at home. Go stack some Benjamins. We'll see you next time back here.
Money in the Morning is created by Joe Saul-Sehy and comes to your ears because of the collective genius of our producer, Richie Rutter-Reese, engineer, Caden Thompson, and a pack of very well-trained ferrets here in the basement. You'll find links to all of our headlines featured on today's show in Joe's Twitter feed at @AverageJoeMoney. I know you already know this too, but Money in the Morning is for entertainment purposes only. You shouldn't act on anything recommended by a bunch of entertainers in a basement without first consulting with your financial advisor, and second, having your head examined. Have a headline you'd like us to discuss? Send them to Joe at stackingbenjamins.com or put them on our Stacking Benjamins Basement closed Facebook group. This show is copyright 2018 Stacking Benjamins LLC, all rights reserved. I'm Joe's mom's neighbor Doug, and I reserve the right to always say, we'll see you next time back here on Money in the Morning.